Welcome. Today we are diving into how to understand and read stock indicators. Getting a good grip on these indicators is going to be your secret to making smarter decisions when you are trading. By the end of this, you are going to have a strong grasp of the most commonly used indicators, and you will know how to apply them to your trades. Imagine having a crystal ball that could help you make sense of the market's next moves. While we cannot predict the future, stock indicators come close by providing valuable insights that help you understand and anticipate market behavior. Let us start with a simple question. What exactly are stock indicators? They are tools that help you analyze price movements and understand market trends. These indicators help traders figure out what the price is doing now and where it might go next. So why are they so important? Indicators are like an extra set of eyes. They give you more confirmation when you decide to enter or exit a trade. Price action gives you a snapshot of the market, but indicators let you dive deeper to understand market momentum, strength, potential reversals, and even chart patterns. Now, let us expand on chart patterns, which are another key aspect of technical analysis. Chart patterns are shapes and formations created by the price movements on a chart. They give traders clues about future price movements and can help you identify buying or selling opportunities. Some common chart patterns are head and shoulders, double tops and bottoms, triangles, flags, and pennants. The head and shoulders pattern is a reversal pattern that signals a possible change in trend direction. It has three peaks, with the middle peak being the highest, resembling a head with two shoulders. When the price breaks below the neckline, it suggests that the trend might reverse from bullish to bearish. The inverse head and shoulders pattern works similarly but indicates a possible reversal from bearish to bullish. Next, let us discuss double tops and bottoms. A double top is a bearish reversal pattern that forms after the price reaches a high point twice but fails to break through. This indicates strong resistance and a potential price drop. A double bottom is the opposite, where the price hits a low point twice and fails to move lower, signaling a possible upward reversal. Triangles are continuation patterns that indicate a pause in the market before the trend continues. There are ascending triangles, descending triangles, and symmetrical triangles. An ascending triangle has a flat resistance level with rising support, suggesting that the price might break upwards. A descending triangle has flat support with falling resistance, indicating a possible downward breakout. Symmetrical triangles have converging trend lines and can break in either direction, depending on the market conditions. Flags and pennants are short-term continuation patterns that occur after a strong price move, either up or down. A flag looks like a small rectangle that slopes against the prevailing trend, while a pennant is a small symmetrical triangle that forms after a sharp move. Both patterns suggest that the market is taking a brief pause before continuing in the same direction. Learning to recognize these chart patterns is essential for making better trading decisions. By combining indicators with chart patterns, you can get a more complete view of the market and improve your timing for entries and exits. Chart patterns help you understand the market's story, while indicators help confirm that story and add extra confidence to your trades. Now let us talk about the different types of indicators you will be seeing. First, we have the trend indicators. These are the ones that help you understand if the market is going up, going down, or just moving sideways. Examples of these indicators are moving averages and something called moving average convergence divergence. Next up are momentum indicators. These indicators let you measure the speed of the price movements. Basically, they help you see how strong or weak a trend might be. Examples of momentum indicators are the relative strength index and the stochastic oscillator. We also have volume indicators. Volume indicators help you track how much of an asset is being traded. They give you a better idea of whether price moves are real or just temporary. On balance volume and volume profile are key examples that you can use to understand what is happening in the market. Volume indicators are especially useful for confirming chart patterns. For example, if you notice a breakout from a triangle pattern, increasing volume can help confirm the breakout's strength. Similarly, a lack of volume could indicate a false breakout, where the price moves temporarily but lacks the support of strong buying or selling. Now let us dive deeper into chart patterns and how volume indicators can complement them. Chart patterns like head and shoulders, double tops and bottoms, and triangles can be powerful tools for predicting future price action, but volume plays a crucial role in confirming these patterns. For instance, in a head and shoulders pattern, the volume typically decreases as the formation progresses, and a spike in volume when the neckline is broken confirms the trend reversal. Likewise, in a double top pattern, reduced volume during the second peak compared to the first is often an early sign that the uptrend is weakening. In triangle patterns, volume generally contracts as the price moves closer to the apex of the triangle. When the price finally breaks out of the triangle, a surge in volume can confirm the direction of the breakout. This is why combining volume indicators with chart patterns can give you a much clearer picture of whether the market move is genuine or if it might lack the momentum to continue. Lastly, we have volatility indicators. These measure how much the price is changing over a given time period. The Bollinger Bands indicator is one of the most popular examples of this kind of indicator. It consists of a moving average with two bands set at a certain number of standard deviations above and below it. When the price moves close to the upper or lower band, it can signal overbought or oversold conditions, but it is always important to look at other signals, such as volume or momentum, to get a full understanding. All right, let us talk about how to read trend indicators. One of the simplest ones is the moving average. A moving average helps you smooth out price data so you can more easily see the direction of a trend. When the price is above the moving average, it signals that the market is in an uptrend. When the price is below, it suggests a downtrend. You might hear about different kinds of moving averages. A simple moving average gives equal weight to all price data, while an exponential moving average gives more weight to the most recent data. Then we have moving average convergence divergence, or MACD. This is used to show the relationship between two moving averages. MACD consists of the MACD line, the signal line, and often a histogram that represents the difference between these two lines. When the MACD line crosses above the signal line, that could be a potential buying opportunity, indicating that momentum is shifting to the upside. When the MACD line crosses below the signal line, it may be a sign to sell, as the momentum is shifting downwards. The histogram is also helpful as it visually shows the strength of the movement. When it grows larger, it suggests that the difference between the MACD and signal line is increasing, indicating stronger momentum. These crosses and changes in the histogram are important moments to pay attention to when you are trading, as they provide signals on potential trend shifts and entry or exit points. Now let us look at momentum indicators and how to use them. The Relative Strength Index is a great one for this. The Relative Strength Index measures whether a stock might be overbought or oversold, and it does this on a scale of 0 to 100. When the relative strength index is above 70, it suggests that the stock might be overbought. That means a reversal could be coming soon. When the relative strength index drops below 30, the stock might be oversold, which could signal a buying opportunity. The stochastic oscillator is another momentum indicator to keep in mind. It works by comparing the closing price to its price range over a specific time period. When the stochastic lines cross above 80, it suggests that the stock is likely overbought. When those lines cross below 20, it suggests the stock could be oversold. Let us move on to volume indicators. On balance volume adds volume on days when the price moves up and subtracts it when the price moves down. If the on balance volume is rising, it means buyers might be stepping in and that the move up could be strong. If it is falling, it means sellers might be gaining control. Volume profile is another important tool. It shows you how much trading happened at specific price levels. If you see high volume areas, they can act as support or resistance levels, while low volume areas show where the price tends to move quickly. Now let us expand further on chart patterns. One of the classic patterns traders watch is the cup and handle. This is a bullish continuation pattern that looks like a teacup, with a rounded bottom followed by a small consolidation resembling a handle. When the price breaks out above the resistance level formed by the top of the cup, it often signals a continuation of the previous uptrend. Volume plays an important role here as well. During the cup formation, volume typically decreases, and a breakout from the handle should be accompanied by a surge in volume for confirmation. Another popular pattern is the wedge. Wedges can be either rising or falling and indicate a potential reversal. A rising wedge is considered a bearish reversal pattern, as the price action forms higher highs and higher lows, but within converging trend lines, showing weakening momentum. A falling wedge, on the other hand, is a bullish reversal pattern, where the price forms lower highs and lower lows within converging lines, indicating that bearish momentum is fading. Again, volume is crucial here. During the formation of a wedge, volume should generally decrease, and a breakout in either direction should be confirmed by increasing volume. The rectangle pattern is another common formation. This is a continuation pattern where the price moves sideways between parallel support and resistance levels, creating a rectangular shape. Traders often wait for a breakout from this range, either upward or downward, as a signal to enter a trade. Volume helps validate the breakout. A rise in volume during the breakout phase confirms that the move is supported by market participants. Another key pattern to understand is the triple top and triple bottom. The triple top is a bearish reversal pattern that forms after the price fails to break above a resistance level 3 times. This shows that buyers are struggling to push the price higher, and a reversal to the downside might follow. The triple bottom is the opposite, where the price tests a support level 3 times but fails to break below, suggesting that sellers are losing control and an upward reversal could occur. As always, volume is a significant factor. A triple top should ideally have decreasing volume with each peak, while the breakout below support should have an increase in volume. Similarly, for a triple bottom, a volume spike during the upward breakout is crucial for confirmation. Expanding on flags and pennants, these patterns are often formed after a sharp price movement known as the flagpole. Flags are rectangular, sloping against the previous trend, while pennants are small, symmetrical triangles. Both suggest that the market is temporarily pausing before continuing in the direction of the previous trend. Volume should decrease during the consolidation phase and increase again when the price breaks out in the direction of the prevailing trend. This helps confirm the validity of the pattern. Finally, let us look at the broadening formation. This pattern is characterized by two diverging trend lines forming a shape that looks like a megaphone. It indicates increasing volatility and uncertainty in the market, with price swings becoming larger over time. A breakout from a broadening formation can be challenging to trade, as it does not always have a clear direction. However, volume can provide some insights here as well. Increasing volume during the formation suggests growing interest and can help confirm the eventual breakout direction. Next, let us talk about volatility indicators. Bollinger Bands are made up of a moving average and two bands that are set at a distance of 2 standard deviations away from it. When the price touches the upper band, it might mean that the stock is overbought. If it hits the lower band, it might mean the stock is oversold. The average true range measures volatility by showing how much the price has moved within a given period. A high average true range tells you that the market is more volatile, while a low average true range suggests the market is calmer. A really helpful thing to do is to use more than one type of indicator at a time. This gives you a more complete picture of what is happening in the market. For example, you could use a trend indicator like the moving average and combine it with a momentum indicator like the relative strength index. If the moving average is showing an uptrend but the relative strength index is above 70, that might tell you that the trend is strong, but a reversal could happen soon because the market is overbought. You can also use volume indicators like on balance volume to confirm if a breakout is strong. If the price breaks above a resistance level and you see a spike in volume, that might be a good sign that the breakout will hold. Chart patterns can also be used alongside these indicators for better analysis. Let us expand on some of the most important chart patterns that traders rely on. The cup and handle pattern is a powerful bullish continuation pattern. It forms as the price makes a rounded bottom resembling a cup, followed by a smaller consolidation period that looks like a handle. Once the price breaks above the handle's resistance level, it often signals a continuation of the previous uptrend. It is very important to look for a surge in volume during this breakout, as this validates the upward move and confirms the breakout strength. Another significant pattern is the head and shoulders, which is a reversal pattern that can indicate the end of a trend. It features 3 peaks, with the middle peak, the head, being the highest, and 2 smaller peaks, the shoulders, on either side. When the price breaks below the neckline, a trend reversal from bullish to bearish is typically confirmed. The inverse head and shoulders is the opposite, where the pattern indicates a reversal from bearish to bullish. Volume should decrease during the formation of the shoulders and increase on the break of the neckline, providing confirmation of the reversal. We also have the double top and double bottom patterns. The double top forms when the price reaches a high point twice but fails to break through, suggesting strong resistance and a potential price decline. It is a bearish reversal pattern. The double bottom, on the other hand, occurs when the price hits a low point twice without breaking lower, suggesting a bullish reversal. Volume is an important element in these patterns. During a double top, decreasing volume during the second peak indicates weakening bullish momentum, while in a double bottom, rising volume during the bounce from the second low confirms the strength of the reversal. Triangles are another commonly observed pattern. Ascending, descending, and symmetrical triangles each tell a different story about market direction. An ascending triangle has a horizontal resistance level with rising support, and it typically suggests a bullish breakout. A descending triangle has horizontal support and falling resistance, often indicating a bearish breakout. Symmetrical triangles, which have converging trend lines, can break out in either direction, depending on the strength of the prior trend. In all cases, the volume tends to contract as the pattern develops, with a surge in volume upon breakout acting as confirmation of the move. The wedge pattern is also crucial for traders to understand. A rising wedge is generally a bearish pattern, formed when the price makes higher highs and higher lows, but within a narrowing range. This indicates that upward momentum is weakening and a bearish reversal could be near. Conversely, a falling wedge is a bullish pattern that forms when prices make lower highs and lower lows within a converging range, suggesting that the bearish trend is losing steam and a bullish reversal might occur. As always, volume plays an essential role, with decreasing volume during the formation and a surge during the breakout providing a strong signal. Flags and pennants are continuation patterns that occur after a sharp price move, also called the flagpole. Flags are rectangular patterns that slope against the prevailing trend, while pennants are small, symmetrical triangles. Both suggest that the market is taking a temporary pause before continuing in the direction of the prevailing trend. A decrease in volume during the consolidation phase followed by an increase during the breakout phase is key to confirming the validity of these patterns. Finally, the broadening formation is a less common but important pattern, characterized by two diverging trend lines that create a shape resembling a megaphone. This pattern indicates increasing volatility and uncertainty as each swing becomes larger. Traders should be cautious with this formation, as breakouts can occur in either direction. Volume analysis can help provide additional clues. Increasing volume during the formation suggests growing interest, and a breakout accompanied by high volume is more likely to be sustained. Let us also talk about some common mistakes traders make with indicators. One big mistake is using too many indicators at once. This can lead to confusion, and it is easy to get overwhelmed. Instead, try to stick to 2 or 3 indicators that work well together. Another mistake is ignoring the price itself. Remember that indicators are tools to help you interpret price action. They are not meant to replace price action. You should always start by focusing on what the price is doing, and then use indicators to confirm what you see. Another common mistake traders make is misinterpreting chart patterns without considering context. Chart patterns can provide powerful signals, but their reliability increases significantly when they are used with other forms of analysis, such as volume or trend indicators. For instance, seeing a head and shoulders pattern alone might suggest a trend reversal, but without a volume spike at the neckline break, the signal might not be strong enough. Similarly, many traders assume that every triangle breakout will lead to a major move, but they may overlook the importance of prior trend strength and market conditions. It is also a mistake to ignore false breakouts. A false breakout occurs when the price moves beyond a support or resistance level only to reverse direction quickly. These can be common in patterns like triangles or rectangles. To help avoid false breakouts, it is crucial to look for confirming signals like increased volume or strong candlestick patterns. Patience is key. Waiting for confirmation can save you from entering trades based on weak signals. One more mistake is relying on chart patterns without considering broader market trends. Patterns like double tops, double bottoms, or wedges are more effective when they align with the overall market trend. For example, a bullish pattern in a strong uptrend is more likely to succeed compared to a bullish pattern in a bearish market. Always look at the bigger picture to determine the overall market sentiment before committing to trades based solely on chart patterns. You also need to be careful when reading divergences. A divergence is when the price and an indicator like the relative strength index or MACD are moving in opposite directions. This can sometimes mean that a reversal is coming. However, divergences are not always a sure thing, so it is important to look for other confirmation signals before making a move. Now let us talk a little bit about how to adjust indicators for different trading styles. If you are a day trader, you might use shorter-term indicators like the 5-minute or 15-minute moving averages, along with quick momentum indicators like the relative strength index. If you are more of a swing trader, you are probably looking at longer time frames like daily charts. You can use indicators like the 50-day moving average and stochastic oscillators to identify trends and possible reversals. If you are a long-term investor, you will want to focus on indicators like the 200-day moving average. This will help you see long-term trends, and you can use volume indicators to confirm major moves. So, to wrap things up, stock indicators are incredibly valuable tools that can help you understand trends, momentum, volume, and volatility. Trend indicators like moving averages tell you the direction of the market, while momentum indicators like the relative strength index let you know if the market is overbought or oversold. Volume indicators like on balance volume help you confirm whether moves are strong, and volatility indicators like Bollinger Bands help you see how much the price is fluctuating. To start using these tools, try adding a few indicators to your charts and see how they interact with the price action. Combine indicators to get a better, well-rounded analysis of the market, and always make sure to confirm what you are seeing before making a decision. Learning how to use these indicators takes practice, but once you get the hang of it, they will become powerful tools for your trading strategy. Keep experimenting and keep asking questions, and soon you will be using these tools to make your trades with more confidence.